Well, so much for the invitation, well, for the introduction rather to today's webinar. It's an unusual one for us, Stu. I think usually we've been doing these webinars now. I calculate this is the 75th one.
Wow. Yeah.
Every month we do a webinar updating the portfolio. It's now 75 months since we started the very first webinar, and we're going to be doing more changes today than we usually do in a year. Wow. But let's find out if everything's working the way it should.
Thanks, Alec. Yeah, those new to the portfolio webinar, there is a little menu on the right-hand side. It's called the control panel. There's a little high-five button there. If you can give us a high-five, you can see Alec and myself, the presentation below us, and then hear my voice. There we go, Alec, we've got some high-fives coming through. That's good to see. And we do like to keep it conversational. I know Alec's got a lot to get through today, but please send your questions. As we run through, I'll pop them onto Alec as soon as we can. But I know it's going to be an entertaining hour broadcast today. Thanks, Alec.
Yeah, and I'm going to get quite a few people saying, what? You've done what? You've sold what? Anyway, shall we get going? Just as far as the questions are concerned, as you send them through, Stu will be checking. And as he checks, he'll then be posing, and we'll start. Hey, Stuart, I look like I am going bald. Look at that. It's like a Alice band.
I think Jeanette gets us with this light, Alec. I think it's highlighting something we don't.
No, we like to stay in the dark. Anyway, we're not staying in the dark today. We are opening up to, well, a very, very big change. But I'm going to just take my camera off. You can look at Stuart if you want. He takes his camera off as well. So let's begin. When you have a look at this, heed the warnings. It's been a while now. You would have noticed from the daily Rational Perspective newsletter that I've been banging on a bit of a drum, saying that this reminds me, the way the markets are right now reminds me a lot of times to be a little bit concerned. Now remember, because of my experience, I've been around a long time. I was going to think of something like age, but I don't want to mention that. But the very first crash that I saw was in 1987, and I just started in journalism in 1980. And it was the very first boom, because in January 1980 the gold price got to 850 and got to like a peak that we never saw for decades afterwards. 1987, South Africa had this uproarious boom. I was being tipped what shares to buy by hairdressers, not the guys at the robots. Those days there weren't that many people at the robots, but it was just about anybody you met. And when you went to parties or went out there, just because you happened to be a financial journalist, you were the center of attention. Hey, Alec, what do you think we should be buying? Oh, my buddy says we've got left cockroaches as the next new thing. It's going to $100. It was R3 at the time, maybe. Well, it did go to $100, but it went all the way back to nothing afterwards. And there were many of those kind of stocks. And I'm seeing a lot of this happening in the current environment. So we are a herd species. We are social. We talk to each other. We do things because our friends tell us to do it. Not all of us, but many people as Homo sapiens. And as a consequence of that, things go in cycles, including and especially markets. And that's really what we're going to be talking about today. So heed the warnings. This portfolio.
Didn't Kennedy say it was in the 20s?
Joe Kennedy.
Joe Kennedy, when he's the shoe shine guy, gave him a stock tip and he went to the house, the trading house, and he sold up.
Yeah, he used to work on Wall Street. Yeah. And that's JFK and Bobby Kennedy's father, Joe Kennedy. And he actually made the fortune for the family because of the shoe shine boy outside Wall Street on his way to work. These guys were pretty dapper back then and had his shoes shined, and the guy was tipping him shares. It's like you get from taxi drivers. When the Uber guy starts telling you what to buy in the stock market, that's the time to be worried. And hasn't quite got there in South Africa, but my goodness, it's like that in the United States right now. So those are that's really the story here. And what have we done about it in the portfolio? First of all, compound annual growth rate, 22% in dollars since we started the portfolio in December 2014, so 75 months ago, and 27% in Rand. Those are big numbers. If you consider that over the last century, the return has been 6% in dollars and 7% in rands. In other words, you invest in South African shares, you got a little bit better than other parts of the world. But that's a long, long way from what we've achieved in the last little while. So let's start off with Ray Dalio. Who is Ray Dalio? He is the manager of the biggest hedge fund in the world, and one of the people that many of us look to, a little bit like Warren Buffett, when we want to try and understand stuff that's very difficult for us. Now, in February last month, he updated what he calls his bubble indicator. And the bubble indicator he put together after going back into history, his own history, which goes back many decades, and then going to what happened in 1929, in the 1960s, and the other stock market crashes, so that he could see or maybe predict or project when stock markets are in a bubble territory, because once they're in the bubble territory, nobody seems to believe it. Even John Maynard Keynes, when he was caught up in the bubble in 1929, the greatest economist who's lived in the last 150 years, perhaps, or so many people believe, John Maynard Keynes sold everything, and then he went back into the market and actually lost a fortune. Somebody else very famous from history who did that was Benjamin Franklin. So there are many smart people who read it correctly, but then get drawn in. And that's why Ray Dalio wanted to make sure that he didn't get into the same situation. And here is his bubble indicator. And this is from that report. It's very easy. Just go onto the internet, put in Ray Dalio bubble indicator, and the PDF will come out. It's a lengthy PDF where he goes into great detail. But what I want you to have a look at is on the far right-hand side, where he talks about emerging tech today. So those 6 questions, it's either frothy or bubble for 5 out of them, only somewhat frothy on the 6th question. So what he says is that emerging tech, and these are smaller companies that are getting towards profitability in the technology field. We've checked this out very carefully because we have a lot of tech companies in our portfolio, but that's the stocks. Those are the stocks that they're talking about, or that he's defining as emerging techs. Whereas the total market, which is now dominated by many of the shares in our portfolio, is high, but not crazy high. And what you don't want to do is be caught up in a bubble. And if you are caught up in a bubble, you can wipe out big percentages of your gain. So when you look at this and you read what Ray Dalio has to say, there has to be at least some alarm bell that goes off for you. Here's the other part of his PDF or his analysis, which has to make you feel a little bit concerned. As you can see there, in aggregate, the market as a whole, still about another 20% before you get to where the market was in 1929, 1969, and more recently, 1999. So, and you can see 1987 is up there as well. So that's where it's above the 80% level, but it's very, very dangerous at that level. Where we are right now for the market overall, you don't have to get crazy scared, but on emerging tech, he says that we're at the 100% level. So that's a signal for us to start reassessing where we are at the moment. Signal number 1. Signal number 2 is what's been going on with market participants. Now, if you'd listened to the Biznews Power Hour last night, and I urge you to do that, we're doing great work there. The team is putting together a show from 5:30 to 6:30. If you're in Cape Town, you can pick it up on Fine Music Radio. If you're elsewhere, you can pick it up on our YouTube channel. That's easy enough. Go to Biznews TV on YouTube, and we broadcast it live. Actually, you can see what's going on in the studio, and on our live stream, which is all over the place on the Biznews channel. And obviously, I also send it out, not me, but myself or Stuart or one of our team send it out on our various social media just before 5:30. So there is the live stream there. So if you want to get it live, there are many ways of doing it. Otherwise, you can go onto Spotify or iTunes and just put in Biznews, and you'll then see the daily recording of the Power Hour. Last night, we had a lot of attention on Archegos, which is a hedge fund that has just blown up in the United States. Now, that guy that you can see bottom left there is a Korean called Bill Hwang. Bill Hwang was the principal of Archegos. He maintains, and you can see these videos on YouTube, that he is being divinely pointed towards the shares that he had in his portfolio, but actually he was hiding them so that the banks didn't know, the banks lending him money against the security of his open margin positions didn't know how overexposed he was. He was something like 500% geared. We spoke last night with the leading hedge fund manager in South Africa, Cy Jacobs from 361. So if you know Cy, or you'd like to hear what he had to say, you can get it on the various Biznews channels. But Cy was explaining that Bill Hwang's position, he had about $10 billion in assets that had been given to him by family offices, but his exposure was about 80 billion. Now that's big numbers. That's about a quarter of South Africa's GDP, just to put it into perspective. That's $80 billion, remember, not rands. So you're really talking about a guy who massively overexposed and was allowed to do that by investment banks. We've heard from Credit Suisse already that they've done $4 billion. We've also heard from Nomura, the Japanese bank, that they've lost $2 billion, and the Archegos Capital Management Fund itself, in which wealthy families invested money, family offices as they called, that's been wiped out. So there's $10 billion gone there as well. And what happened in this case was that this guy played on margin. So he put a little deposit down and then took big bets. And the stocks he took big bets in included Spotify. Now, this is a very worrying situation for us because Spotify is a great company. Nothing wrong with the underlying business there. And we still believe that it's going to be one of the big winners in the move of audio from on demand, in other words, on radio, to when you want to consume it. And that is a big move. We've seen the massive changes that have happened in the television market. But the fact that Bill Hwang has a big position in Spotify, which may or may not have been unwound, we don't know that yet. We just know that it's starting. It's a little bit like what happened in 1989 with long-term capital management. A similar situation that we're going through here. And we don't know where it's going to go, and we don't know how it's going to impact Spotify, but it does give you a pause. And then secondly, on the top of the screen is Wall Street Bets. That is the mob, if you like. It's like the Shoeshine Boys on Wall Street in Joe Kennedy's days that Stuart was referring to. It's the small investors, and they are bulletproof, they believe. And they've had a few successes over the hedge fund managers, but they also, if you have a look through the lines or between the lines on Reddit, which is an internet notice bulletin board, really, they do G each other up, but they also have lost a lot of money. And that is the reality of what happens in the final stages of a bubble, is that retail investors get sucked in. We have apps nowadays where you literally can trade without paying any commission or any fees on it. Very, very different to the past. You can also trade in fractions. So you can buy 100 rands worth of Amazon stocks. In the past, that was protected to a degree because individuals were forced to buy 100 shares of Amazon, and today they cost you R500,000 at least. In fact, probably a little more. So the retail investor has been able to participate far, far more than ever before. And what does he like? Well, he likes the stocks Bill Hwang liked, which is the high beta, highly geared emerging tech stocks that Ray Dalio tells us is in a bubble. And then finally, on the right-hand side, is a lady who's shot to prominence from nowhere. Her name is Cathy Wood. Her funds are the ARC funds. Interestingly enough, she and Bill Hwang both maintain that they are Christians and that they are doing God's work. That's always something. I don't believe God picks favorites, and I don't believe that if you are doing God's work, you should be out there advertising it. He certainly doesn't, whatever. But let's not go into that side of it. But quite often we have seen people who have used religion as a way of justifying some extreme ideas. And Kathy Wood is also heavily invested in the high beta emerging tech stocks. So you've got this participation or market participants. One has already blown up, Bill Huang, and that's one of the biggest hedge funds with positions of $80 billion, as Sarah was telling us last night. That is massive, even for Wall Street, for anywhere in the world. And you've got Kathy Wood, who's gone from about a $2 to $3 billion fund to over $50 billion, because as she's had success, so the money has followed her. These are very, very loud alarm bells that are ringing. But then the clincher, and I've been saying this in this webinar for some months now, it's fine. The governments are producing money as never before. All is well as long as interest rates haven't started rising. But there you can see June, July, interest rates bottomed last year. And this is the 10-year yield on a Yahoo Finance. You can go and have a look at it yourself. Last night, it broke above 1.75% for the first time. And you say to yourself, well, what's 1.75? That's ridiculous. You know, that's very low. Well, sure it is, but the problem here is the trend. And as interest rates start rising, investors have an alternative. Up to now, you really were concerned about going into property, especially commercial property. You were concerned about going into cash because cash was trash. You were getting too low an interest rate. But now that interest rates are starting to rise, it's becoming an alternative. When you've got inflation way below 1.75%, it's becoming an option for people to switch money out of equities into interest-bearing deposits. And that's always a very, very strong sign that the best is behind us. So there are 3 warnings that we are heeding in the portfolio and making some changes today. Ahead of the changes, there's the portfolio as it stands. And I'll show you in a moment that it's been a very tough month that has occurred in the last month for most of the stocks in the portfolio, apart from Wilson Bailey, which, by the way, you can see is still a little bit in the negative there. That is in anticipation of a infrastructure surge in South Africa after late last night's developments at the ANC's National Executive Committee, where Cyril Ramaphosa finally got rid of Ace Magashule. There's a very good article on Biznews that you can go and read, written by Nick Borain, a top political and financial analyst. He stayed awake until I don't know what hours of the morning to write that piece, and with his permission, we republished it this morning. So Ace Magashule is finally out. That is the big battle that Ramaphosa was fighting. He was always going to win it, but while Magashule and others had power, it was going to bedevil any attempt for South Africa to get its economy back on track. Now, I would have thought that Wilson Bailey would be one of the beneficiaries of this, because once we know that South Africa's economy needs an infrastructure development to get the economy going again. So WBHO is one there. You might remember it got as low as 80 Rand a share at one of the webinars, and we decided to stick with it. 2U is in a way an emerging tech stock, and so Zero, both of those fairly recent additions. 2U in July last year. Zero, we've just finished doing the purchases, both down very slightly in US dollar terms. And both of those are companies that are either at or close to profitability and with big opportunities going forward and well capitalized. So they're going to both stay in the portfolio. Also, they're not overvalued, as you'll see in a moment. So that's the story there. In the past month, the reds are the percentage declines, and you can see Spotify, 2U was sucked along with that, but both Spotify and Cloudflare taking quite hits from significantly elevated positions. Spotify down nearly 28%, affected by Bill Huang. Now, Spotify is also a big stock, as I mentioned earlier, in Kathy Wood's portfolios. So you're starting to say, well, let's have a look at Spotify. And although we know the promise, it's a great company, we know where it's going to, could it be that when these warning signals get heeded more broadly, that Spotify will be one of the losers. It's already down significantly, but is it now at a level where you can hang in there? Similarly with Cloudflare, and I think you'll see that's not the case at all. So that's just move on to the next one. Warren Buffett is saying, always says to us, you know, he's got a lovely saying. He says, if a person walks through a door and they're 310 pounds or 320 pounds, you don't need to know the exact figure, which one is right, 310 and 320, to know they're fat. They're fat. Look at the obvious. And we're examining the obvious here. And what I did was I took the market cap of all of these companies. This is in millions of dollars for the most part, excepting Naspers and Discovery and Wilson Bailey, which are in rands. And then looked at the annual revenues. So we're taking the revenue multiple. And as you can see, Amazon is trading at 4 times revenues, not profits, revenues. Now with exponential companies, you can be comfortable by assessing them on revenues. But of course, sometimes the revenues or the revenue multiples can just get out of whack. And that's exactly what's happened with Adobe Systems. It's 17.5 times the annual revenues. Now, Adobe is a really good company. It's given us PDFs, it's got lots of software, but at 17.5 times revenues, you are really, really asking a lot of a company that's growing about 20% a year to continue to maintain that rating, especially when you compare it with Microsoft, which has got much stronger products at only 12 times or relatively 12 times revenues, and Apple at 7.5 times. Now I'm in a minority here. Lots of people are worried about Apple's price. They feel that Apple is excessively priced at 7.5 times revenues. I'm quite comfortable with that, given that the ecosystem that Apple possesses is something that is very, very hard to value. And if it was at 12 or 13 times revenues, I think you'd have to start worrying. But at 7.5, I can still make a case that it's not overvalued. Adobe at 17.5, however, in the kind of environment that we could be going into, where emerging and tech companies get more closely assessed, and looks expensive. As you go down the list there, look at Naspers, 4.5 times a revenue multiple, which is actually by any measure very cheap when you consider that its main asset, more than 100% of its asset, is in an internet giant, which should at least be trading at a similar multiple to Apple. But that's because Naspers is trading at a 50% discount. Netflix at 9. You could argue, some would argue that that's rich. However, Netflix is now starting to make money, and it's now starting to be able to manage its cash flows a lot better. I still think that Netflix, when Reed Hastings tells us, is fighting against free-to-air television, not against other streaming television services, that the runway is very, very high. Discovery is hard to assess because the annual revenues there, although they look very low at 1.4, it's also not quite the same kind of revenues that you would be looking at with some of the other companies, but it's still, Discovery's still got a long, long way to go in terms of realizing its global potential. Look at Wilson Bailey at 0.13 times revenues, but that's because it's a construction company and the margins are tiny, especially at the moment. And then we get to Spotify at 5.2 times revenues. It isn't really screaming out at you that we got to get rid, but it is when you combine it with the fact that it has been put into some high beta portfolios and it's losing a lot of money still. So whereas Netflix is making money now, Spotify isn't. So it's still got quite a way to get to profitability. At 5 times revenues, you've got to be a bit concerned. I'm not at all concerned with 2U. It is profitable now, or very close to it. And at 3.6 times revenue, that's not excessive for a company that is the dominant player in the tertiary online education. But then you look at Cloudflare, one of our favorites, 47 times revenue. That's exactly the kind of stock that will get smashed in its share price. Great company again, but to justify 47 times revenues, it's got to be better than great. And it is the kind of company with $400 in revenue, $400 million in revenue, and 20 billion in market cap that is like standing out like a sore thumb in our portfolio as one that is vulnerable. What are you asking for? Get to 50 times revenue, 60 times revenues for it to appreciate from the current levels? Of course not. And then finally, Xero, which we've just finished doing our buying of. You look at that at 22 times revenues and you might start getting a bit concerned. However, Xero is only just starting on its journey and it's profitable. So a consequence of that, I can make a case for 22 times. Why is that? Because Xero is the best accounting software in the world. It's dominant in Australia and New Zealand, where it comes from. In fact, it comes from New Zealand. It's starting to dominate here in South Africa, and it's doing the same thing in the United Kingdom, and it's also only now just moving into the United States. So that revenue multiple, as it stands right now, I'm not worried about it at all. It is a very, very high growth company that's starting. It's got a globally superior product, and it's starting to get into the international market. So that's the way to examine the obvious. You look at this, you say, well, you got to sell Cloudflare, you got to sell Adobe. Should you be selling Spotify? Oh my goodness, Bill Huang and Kathy Wood have both got big stakes in Spotify. Maybe you should. So that's the decision that was taken. So out they go, raising $91,000, and they've served us well. So one of the things you should not do when you invest is become sentimental. There's a lot of sentiment, I suppose, in a company that you bought a year ago and it's given you 169%, but that's not what it's about. Right now, Cloudflare doesn't seem to have much price opportunity into the future. It's a great company, and I've no doubt it'll remain on our radar, and at some point in time it'll offer great value. That $24 a share, you'd be jumping at it. But right now it's $65 a share, not so much. Similarly with Adobe and Spotify, which have both served us extremely well. As you can see, they're 88 and 70% respectively. Xero's purchases have been concluded. Interestingly enough, Xero went down to $102 Aussie dollars a share. We should have bought it in between the two purchases, but the first lot was 137, then 120 and 125, which is the current price in Aussie dollars. It is a stock that I'm very happy that we've got in at a price around about $100 a share for these shares. But it also again emphasizes the benefit of not buying all of your purchases on day one, but to spread it out over 3 months, as we've done in this case. Had we bought them all in day one, we'd be sitting with a purchase price of $137 in Aussie dollars a share. As it is, we're sitting around 120 odd. So it has paid dividends again. And there's the portfolio today, as it now stands, with the departure of those 3 stocks: Adobe, Cloudflare, and Spotify. And it's sitting with a healthy cash balance there of $91,000. As you can see, the percentage there is again, it's the most cash we've had in a long time at 13%. We've got some, I suppose you could call them speculative positions with 2U and Xero, certainly higher risk positions there, but that makes about 10% of the portfolio. You've got roughly 4% in Wilson Bailey, and the rest are in real solid stocks that we're pretty happy, have held for a long time, and will continue to do that. Interestingly enough, in the last year, this portfolio is up 53%. So from where it was sitting in March 2020 to today, and in March 2020, with the pandemic coming through, there was a lot of panicking, and many people were selling shares. We didn't panic. In fact, we bought more. You might recall that we bought Sasol and Discovery at that point, and of course, Cloudflare. And all of them that we bought into did very, very well indeed. Very quickly, the individual stock performances. I'd like to put this up on the screen to remind us that this portfolio has done as well as it has, thanks to Amazon and the incredible performance that Amazon has achieved in the past 6 years. If you have Amazon if you've been holding Amazon in your portfolio for 6 years, you could not fail to have done very well. You've had to have done some really dumb things elsewhere to be on the wrong side of zero. And you can see there that it just keeps you humble when you look at this and you say, okay, we would have done well with the others, but Amazon, wow, that's really made the performance and the portfolio as it stands today. Stu, that's the formal part. The first half of the discussion today. Let's get into some questions.
Excellent, thanks, Alec. There's just a question on Slack. I know we sold it. John wants to know when we sold and why.
We sold Slack when there was an offer by Salesforce. At the time, the view was that the risk of holding Slack was high. If for some reason the offer from Salesforce had not gone through, so if there'd been some spoke in the wheel, then we would have lost out on our nice profit that we generated from Slack. And so there was really no point in doing that, in holding on to Slack. As it happens, we sold it pretty much at the top of the market, but it wasn't any of our doing. It was Salesforce's doing. Salesforce made the bid, and which has been concluded. Slack is now off the market, I think.
Yeah, thanks, Alec. Thanks very much for that. Germany just wants to know, if you have a 20-year time horizon, should you time this market and sell or keep it and buckle down?
A 20-year time horizon. If you go back to 1999 and you'd bought Amazon at the top, the ultimate top of the market, before it dropped by 93 or 97%, and you'd held on right through all of that, you would still be showing a multiple on your initial investment. But if you'd bought it after it had fallen by 97%, it could have changed your address. So I don't believe that anybody's smart enough to time markets. But what you can see sometimes is that the obvious is showing you, and I'll go back to that revenue multiple number. It's pretty obvious here that some of these stocks haven't got a heck of a lot of upside, at least in the short term. And they've got a lot of downside in the short term. Cloudflare is a big one there. It doesn't matter how well Cloudflare does over the next few years. To justify 47 times sales, or to justify a market cap of 20 billion Rand when you're only generating 430 million Rand in revenue, wow, that's something. That's going some. So I do think that you need to continuously reassess the stocks you own, and if they have gone too high, then relative to the intrinsic value that you worked out in the initial stage, then you have to drop the sentiment and say, well, maybe there are better places to put my money. So sure, some people will say, buy Cathy Wood's ARK funds, ETFs, because in 20 years, they're going to be worth a lot more than they are today. And that's not a bad strategy if you rand cost averaging or dollar cost averaging. If you believe in the philosophy that she's giving us and you start putting a certain amount away every month, you won't go wrong. But if you're already sitting with a big portfolio like we are here, you need to re-examine the holdings that you have. So I wouldn't close my eyes, no.
Thanks, Alec. Schwab wants to know, would a market crash affect the JSE proportionally to the US market, given the fact that we are PE cheap and been on a downward spiral anyway for the past 5 years? Do you think we should just sell everything?
No, I don't think you should sell everything. And it isn't, again, let's just go back to that graph here, the bubble gauge percentile. South Africa's stocks are, American stocks, which are more highly valued than South Africa's or highly rated than South Africa's, are not as a whole in bubble territory. And you can see that from Ray Dalio's bubble indicator. They were in 97, 98, and they were in 1929. They were in 87. We're a long way from 87, at least another 20% from 87, and in 71. And remember, the other thing that we're talking about here is that there's been massive creation of money. So when money is created to the degree that has happened in many Western countries, then it will make assets worth more, relatively speaking. But what bothers me, and what should be bothering everybody, is this graph, that interest rates are starting to rise again. It's starting to become more expensive to borrow money. When you see down there that interest rates are going to almost zero in the United States, as it did in 2020 and, well, during the pandemic, effectively. They just opened up the printing presses. But now that's not the case anymore. Then you need to reconsider. Is there going to be a market crash? I don't think so. When you look at this bubble indicator, the market as a whole in the United States is not in a bubble. However, when you look at that, the emerging stocks, the stocks like Cloudflare at 47 times revenues, that's crazy stuff. That's not what you will see in a normal market. Would Amazon be able to be justified a 4 times revenue multiple? For sure. I'll happily continue to buy Amazon shares at the current price. Similarly, Apple, although Apple could have a little bit of downside in it, when you have a look long term for Apple, 7.5 times revenue multiple, to me, if the market were to crash from these levels, I'd be taking out second bonds and getting my hands on anything I could to bulk up on those stocks. But there are some, those emerging tech shares, which you need to look at. You know, we as South Africans should understand this better than most, because we have had in our country two markets in one for decades. We've had the resources sector, and then we've had the rest of the market, financials and industrials. And you could have a resources sector which is surging and financials and industrials which are depressed. And then you could see the resources sector that comes under pressure, and you then say, oh, the market's crashing. Well, it's very rare that you get both of those that go up, as they did in 87, 2007, and so on. So this indicator is saying to us, be very, very careful of emerging tech stocks. It's telling us to be careful of Tesla, but I've already burnt my fingers, or we sold Tesla in 2018. And at these levels, well, the people who bought it $880 are probably feeling pretty sick with it down at 620, but still it's massively inflated relative to where it was when we saw that believed there was the stock was fully valued. So one doesn't know. As Keynes said, the market can be irrational for longer than you can have money in the bank. That is a reality of it. But it doesn't look to me like we're heading into, and certainly what Ray Dalio is saying, that the whole market's going to take a smack. Emerging tech, however, is where you need to be cautious, and that's why we've done what we've done.
Thanks, Alec. George has a question. I think I know your answer to the stock, but he really likes British American Tobacco. And he says, can you please ask Alec to test this share as a representative of old school high divvy value shares against the Ray Dalio bubble matrix?
Well, it would be nowhere. I mean, it would be no bubble, no bubble, no bubble, no bubble, no bubble. Everything you look at. The price is not high relative to traditional measures, not when you're looking at nearly double-digit dividend streams. They're not discounting, and well, already it's discounting unsuitable conditions. It's all in the price. The legal issues against British American Tobaccos. New buyers have entered the market. No, nobody wants BAT. That's why you can get it cheap. There's broad bullish sentiment. No, it's the other way around. Purchases are being financed by high leverage. Absolutely not. And buyers, businesses have made extended forward purchases. Again, absolutely not. So it's the inverse of a bubble right now.
Thanks, Alec. Andrew says, if investing monthly into shares in the global portfolio, do you have any advice as how to decide what to buy each month?
If you're investing monthly, I would really go with this portfolio that we have, We think about it a lot. We follow these stocks a lot. We come back every month to give you updates. When we get the quarterly numbers, we put them in context. That's the whole purpose of this webinar. So you can, if you're able to, you should be trying to purchase these shares on a monthly basis. They're the ones that I would be going for. However, you can also find exchange traded funds, which would reflect a lot of this. I know Magda Wazic's Fourth Industrial Revolution Fund, which looks into the future. I'd be a little cautious on that at the moment because it does have a lot of emerging tech stocks. But as she was telling us the other day on our Biznews Power Hour, more than 300 shares in that portfolio. So massive diversification. And to me, you get so much fun by participating in the greatest game that exists on earth. You know, I like playing chess, but chess has got nothing on investing in shares. Chess, you find a new opening, you might win a game through it, and you pat yourself on the back. When you invest in shares and you find an Amazon at $327, there are very few feelings that are quite as exciting as getting a 10-bagger like that. So the more you participate, the more you know about the greatest wealth creator for many, many people, millions and millions of people. And you should participate in it. Some will say, but property is a better wealth accumulator. And maybe it is because you get to gear in properties. You only put down a small percentage of what you're investing, and the rest gets lent to you by the bank. But that still brings with it obvious risk as well, because if the property price goes down, you might be underwater for many, many years paying a bond on a property that is undervalued, it's worth a lot less than even the bond that you have. Whereas in equities, you can get in and out for very, very small percentages, very small trading costs. It is it's interesting because the participants are all around you. You can buy Coca-Cola shares, you can buy Netflix shares, as we have, Microsoft, because you might use PowerPoint as we do here. It really is something that I would encourage everybody to just participate in, and it's like most things in life. Once you go into the area, you learn by experience.
Excellent, thanks, Alec. Sean, it's a question we get asked quite often. How does one buy into the portfolio?
There isn't a portfolio per se that you can go to Standard Bank with and give them 100 Rand and say, I want the Biznews portfolio. It is a model portfolio. And the reason we've done this, we did at one stage with Easy Equities have an actual portfolio which replicated everything that was in here. The problem was it's done so well, and you can see that it's gone from 2.25 million Rand to 10.5 almost million Rand in 6 years. Now, a little bit like Cathy Wood, when you get those returns, people say or extrapolate that, well, that 10 is going to become 20 or 50 or whatever they want to extrapolate in the next 6 years, which of course is crazy thinking. But if we have too many people who are buying into the portfolio, and that's what happened, there was just a flood of money going into the portfolio, or what they called a basket at Easy Equities, that I got very nervous and said, that's not the purpose of this. The purpose of this is to get people to see options or possibilities that they might invest in, and then make the investment and follow it on a monthly basis, and we can update it. You won't see, for instance, Bitcoin in here, even though we have been told by very smart people that it probably makes sense to have between 1% and 2% of your portfolio in Bitcoin, no more, 1 or 2%, because who knows what's going to happen there. We had Cy Jacobs from 361 last night saying the same kind of thing, was that it is a limited, there's only so many Bitcoin that have been made, and as a consequence of that, we don't really know what the upside is. We had someone on Bloomberg yesterday telling us that they think the Bitcoin price is going to $1 million. You just don't know. On the other hand, you've got Noura Rabini, probably the greatest economist in the world today, saying it's all a big scam. So who knows? When you don't know something, just step away from it. Let somebody else take the risk. But when you do invest in a company like these, you pay attention, you read the annual reports, you watch the quarterly investment calls, and you stay on top of where your money is and see how it's working. So that's kind of the idea of the portfolio. It isn't something, I'm not a money manager, and I don't intend ever becoming a money manager. And that's why we closed down the direct option.
Thanks, Alec. Here's a tough one from Dave Willem. He says, isn't the latest trend of measuring value using a revenue multiple not a trap that will end in tears? Ultimately, value creation comes from growth in intrinsic value plus dividends, and intrinsic value comes from profits, not revenue.
Of course, and you're absolutely right, Dave, and far be it for me to argue with you. However, where my mind about investments changed was in 2014, when I was exposed to the faculty of Singularity University, Peter Diamandis and co. Up to then, I was very much an intrinsic value investor, Buffett way, full on. I'd work out my intrinsic values as Buffett does, work a discounted cash flow, what are the growth rates that we expect to come from that company, and so on. But when you start putting exponential numbers in there, 20, 25%, look at this, for instance. This portfolio has grown in US dollars by 22% a year for the last 6 years. Doesn't sound like much, does it? You got lots of companies, by the way, that are delivering 22% growth in their revenues, in their bottom lines, and holding their profit margins or getting ready to open the profit margins when they need it. Apple and Amazon being obvious examples of that. 22% has taken this portfolio from $200,000 to $700,000 in 6 years. And that's what we're looking for. We're looking for exponential companies. Now, when you look at this portfolio, everyone barring Wilson Bailey, which, as I've mentioned a few times, is a special play on the South African infrastructure. Every one of these companies is an exponential company. They're growing at 20% plus. Discovery, you might say, is a little different, but Discovery's real value is not in South Africa. Its international exposures are massive. Have a look at Ping An Health in China, which is growing at more than exponential levels. They're growing there, they're adding a number of clients, and Discovery owns 25% of it, by the way. That Discovery has total clients in South Africa. They do that in well, less than a year. So that's the story here. It's not a story about intrinsic value, incremental growth. It's a portfolio that is trying to help us get our heads around this new fourth industrial revolution, as it's now called. Actually, I prefer what Andy McAfee and Eric Brynjolfsson described as the second machine age. They were ahead of Klaus Schwab, kind of from the World Economic Forum, took the second machine age, and then I suppose they had to call it something else. But there's a great book called The Second Machine Age by those two fellows, Brynjolfsson and McAfee. In there, they're talking about this massive, massive shift that is happening to economies and is also happening to sectors in the economy. And in that way, the winners grow exponentially and the losers go out of business. And we're seeing this in having been accelerated by the lockdowns due to the pandemic. So, Dave, I get what you say, and you've analyzed Tongaat, which I can't find. I can't work it out on how. I know it was very cheap, but I can't work out where it's going into the future. So we haven't bought Tongaat in this portfolio. But on the other hand, it's kind of the obvious stuff here, the Buffett obvious stuff. And the best way to just look at this exponential portfolio and see, well, what are the thumbs that are sticking out on the obvious side? And that was why I used revenue multiples. I don't base the purchases of the portfolio constituents on revenue multiples. This was just done to see where are the sore thumbs that we should be very cautious about, given the view that with Bill Huang and Archegos and Cathy Wood and the exposure there, where are we exposed? And that's why we made this unprecedented. We've never ever sold 3 stocks in a month.
Thanks, Alec. EJ just wants to know, how do you get the revenue multiple of a company? How do you work it out?
You take the market capitalization. In other words, what every share, if you took every share that was issued by the company and multiplied that by its current share price, that gives you the market capitalization. So if you were able to acquire the entire company today at what the shares are trading at, that's how much money you'd need. For Amazon, you'd need $1.549 trillion. And then you take that you take the annual revenues that it's generating, and you take that as a multiple. So to get to the market cap of Amazon, you'd have to take today's revenues and multiply them by 4. That's 386 times 4 will get you 4.01, will get you to 1.549 trillion. Amazon does $386 billion in annual revenues. Apple does $274 billion. It's a very, very rough guide because there are vastly different profit margins that are generated by each of the companies. You get Cloudflare, for instance, which is generating a profit margin of well over 50%. The problem there is that because capitalism means that when you have excessive profit margins, you get competitors jumping in because there are no barriers to entry. The profit margin of over 50% doesn't last. So if we wanted to go into great detail, we'd have to put the profit margins there as well, and then say, well, is the revenue multiple justified against the profit margin, and so on. I didn't want to do that. All I wanted to do was to say to you, if the person's walking into the room and they weigh 310 or 320 pounds, they are fat. And let's look at what was fat.
Thanks, Alec. Sean Griffiths was wondering, what do you think of alternative electric vehicle manufacturers that have been in the shadow of Tesla, for instance, the likes of VW and Audi?
Whenever there's hype, as there has been with a stock like Tesla, that stock will become overvalued relative to its peers, because the tribe or the fan club would see it as a movement, as they do in Tesla. People who've bought Tesla shares, particularly the retail investors, they're not worried about the matrices. They just want to be part of Tesla. They can't afford a Tesla car, perhaps, so they're buying the shares. Or they can afford a Tesla car and they're buying the shares as well. If you start looking at the second liners, the third liners, as you say, like VW, General Motors, and so on, then you just got to do your homework and you've got to do your analysis and then start working out how they migrate from internal combustion engines to electric engines. Are they able to do that? We know that many newspaper companies went bust before they were able to digitize or become digital companies, digital media companies, because it is so hard to change the culture. And that's something else that investors will look at and say, well, you know, Elon has come out as an electric vehicle company. He doesn't have the legacy of somebody who there might be pet projects that are related to internal combustion and so on. So it's a very tricky situation. But what I would urge against is saying, well, Tesla is trading at X, so Volkswagen should be at least half X based on what Tesla's X is. Maybe Tesla's X is massively overvalued as well, and then you fall into the trap of overvaluing Volkswagen. So it's a very, very tricky field. For me, the best way to invest is to find companies that are growing exponentially as a consequence of being beneficiaries of the massive change that we're seeing that is happening in our lifetimes as the technology era takes over. It's a little bit like in the previous revolutions. If you think back to the personal computer and how that changed life, or if you were alive back in those days when steam came along, or when electricity started changing the world, what we have right now is one of those seismic shifts. So rather than trying to play the second rankers or those who are in the old economy who are very cheap, but they could transform into a new economy company, rather look for exponentially growing new economy companies that are not overvalued. And Cloudflare is a fantastic business. They dominate the global internet security business. Dominant. But at 47 times sales, you're betting that they're going to hold on to that indefinitely. So that's where your problem comes there. But to you, for me, is a fantastic option at its current market cap of under $3 billion, because it's the dominant player in online tertiary education. And if there's one thing that the pandemic has taught us, it's to use our time more effectively and to invest in ourselves, which again, getting back to Warren Buffett, is exactly what he will always tell you. In fact, when you walk into Omaha Airport, you'll see there's a big advert there for Nebraska University, where Buffett did go for some of his studies. You've got a big picture of him, and the tagline is, Warren Buffett says, invest in yourself.
Thanks. I see this usually the quickest hour in my month. I think we're coming to the end of it. So there's a few questions we just wrapped into one. Is what are you looking to do with the cash, or when you're looking to deploy it? And then just off that, Julian says, do you ever consider repurchasing shares that you've sold?
Yes, Julian, definitely. If you've done the work on the company and you really like the company, if the company becomes better value, then you will buy into them. With both Spotify and Cloudflare, the stocks were never at a level, although I watched them for a long, long time, great companies, but the stocks were never at a level which made sense to buy into them until they were. And that's exactly, I've got them on my watch list and I'll keep watching them. The same with Adobe. It's a great business. Just 17.5 times sales. That is something that we will be doing into the future. What to invest in? I'm very lucky. I get every night to spend an hour talking to really, really smart people, and they come up with great investment ideas. Sometimes there's David Willem, who's on this call, when he and Chris Logan were talking about Tonguat. It wasn't difficult to work out from what they were saying that if the new management team got things right, then Tonguat at, what was it, 4 Rand a share was a steal. But you needed then to go and do your homework on Tonguat, and I just couldn't work it out. I knew it was cheap, but I couldn't see where the runway was coming from 10 Rand onwards. And that's where it is now. And maybe there is runway, maybe 20, 30, whatever the case might be. But Piet Viljoen at our Biznews investment conference, and I urge you, if you're going to go to any conferences, come along in September. What I love about our conference is that all the speakers hang around for the whole time. So you get to rub shoulders with them. It's very informal. You get to talk to them, and they really are. They're selected because they are independent thinkers and think differently. We've got a pretty good lineup coming in September. But at our conference, Piet Viljoen identified 4 stocks that I haven't done my homework on. Of course, they've all blooming moved now because everybody's sitting in the audience, listened, probably did their homework a lot more quickly and went and bought them. Amongst them, Sabvest, which came out, as luck would have it, a week later with results, very good results, and then shot up 15% on the day. He also mentioned Lewis Stores, which my colleague Justin Rowe Roberts has written a piece on for Biznews, which I haven't looked at in enough detail to say, let's put it into the portfolio. But there are always opportunities that are available. I like the exponential companies, but from time to time, as we did with Sasol when we bought it at 27 Rand a share, there are some absolute sitters. So there's nothing wrong with having a little bit of cash, as we've now got with 13% of the portfolio in cash in a choppy market as we have now, which will also enable you to be able to deploy or redeploy that cash should there be a significant pullback.
Excellent, thanks, Alec. I think it's just past 1 o'clock, so I think we need to shut off now. I will put the video back on, get the video uploaded to the Biznews TV channel on YouTube. I have put the link on the chat there as soon as possible for anyone who wants to have a re-look at what we've gone through today. So, but towards that as soon as possible after the webinar finishes, Alec.
Yeah, and I suppose we need to make sure you're not talking to cardboard cutouts. Here we are in our little our little studio here at WeWork.
Yeah,
we're moving at the 1st of May.
1st of May.
And you're not going to believe the new studios. Anyway, it's needs must at the moment, and at least it's coming through okay, all good. WeWork have been very good to us, looked after us here, but we'll be moving to pretty smart studios, another step in the progress of the Biznews story, and that'll be from May onwards. So
no carpets in the background, Alec.
Don't tell them. I mean, the point is, if we just look at this on the screen, as you can see Stuart there, what he's got in the background is very sophisticated soundproofing. It's actually a carpet that Jeanette found somewhere, whatever. That's what you do when you're a disruptive startup. Thanks for being with us. We'll be back again last Tuesday of every month.
And 5:30 tonight, Alec.
Of course, 5:30 tonight on the Biznews Power Hour. Join us if you can. It's great fun, and you'll see it's kind of a different program to the one that I used to have 15 years on prime time in South Africa. We're coming a little earlier to you at 5:30. You're in Cape Town, it's a pleasure. Just put it on to Fine Music Radio. If you're not in Cape Town, you can pick it up on your phone with the link to our live stream. Or if you're sitting in front of a computer or a laptop, you can watch it all on YouTube, and it's actually fun. It's quite fun, the YouTube one. You see how the sausage is made. And sometimes it's a little embarrassing, but whatever. It's the content that comes through, which is the bit. Thanks again. We'll be back again tonight at 5:30, and of course for this webinar
last Tuesday of every
month. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.